Hey guys, welcome back to my channel. Thank you so much for subscribing. Thank you so much for deciding to stop by. Today we are going to wrap up our financial series. So far we have discussed the top investment myths in Jamaica. We have discussed some investment terms that you need to know if you're going to start investing. I've even gone as far as to show you certain investment strategies that you can implement if you choose to become an investor. Today, what we're going to talk about is, should you invest while having debt? Should you invest if you have student loans? Should you invest if you have a car loan? Should you invest if you have a mortgage? So we're going to explore this question because, believe it or not, this is a question I get a lot, and this is a problem I see as a personal finance coach at the Money Society. I see this a lot with my clients. So we're going to discuss this and dive right in. Now, before we can ascertain whether we should pay off our loan or if we should not invest or if we should invest, the thing that you need to sit down and figure out, you need to really look at, you need to really figure out is your budget. Budgeting is such a fundamental activity. It's such a fundamental task that you have to do. If you don't have a proper budget, best believe, honey, you're gonna be stagnant or your situation is not gonna improve. Budgeting, I think, is the holy grail. That's what it is. I don't think the pay yourself first principle that experts say is the first thing you need to do. I think the first thing you need to do is to establish a proper budget. If you have a proper budget, there's a good chance you'll be fine. Let's say you have established a proper budget. The second thing we need to look at is whether you have an emergency fund. If you don't have an emergency fund, I say it all the time in my videos, but in case our new subscribers haven't watched any of those videos, I'll reiterate. If you don't have an emergency fund, that needs to be your top priority. That needs to be your top priority. Having an emergency fund is something that is so integral that it can literally stand between you and financial ruin. Now, let me explain to you why I say that. If you don't have an emergency fund and an emergency arises and you have to pay for it, there's a good chance you're going to have to liquidate or wipe out your investment portfolio or your financial portfolio. And that is the best case scenario. You hear me? The best case. Did you hear what I just said? Investment portfolio being wiped out is the best case scenario. I hope you just heard me, because that really is the best case scenario. If you don't have an emergency fund and you don't have an investment portfolio to liquidate, you won't be able to afford the emergency. So if it is that you need to do a surgery or you need to do some tests or there's something wrong with you and they need to give you some medication or something, you can't afford it, then what's the alternative? You're gonna go to GoFundMe and put your life in the hands of some strangers? That spells absolutely no sense to me. Just put a proper budget in place and make sure you have an emergency fund. Once your emergency fund is taken care of, we can now look to investments. I would say that you start with the easiest forms of investments. And I say this because, I'm not talking to you as an expert. I'm talking to you as somebody who, listen, I have failed and started over so many different times. I'm talking to you as somebody who has done this. It's practical information. Start with the easiest investment first. Then wait till I say no investment are easy, but I do agree with that. Pension. If your employer matches your pension contribution, you have to make sure you contribute to pension and make sure you max your pension. If your employer is matching yours, make sure that you max it. What do I mean by that? By law, and this is not legal advice, but by law, the most you can contribute is 20% of your income. Let's say your employer matches your contribution, the most you can contribute is 10% of your income, because your employer is going to put another 10%, and so the total will be 20%. Don't make it be a case where you're contributing 2% and your employer is only going to match that with another 2%. That's 4%. You left 16% on the table. So make sure you sort that out. This money is for you in the future, okay? It is investing. You are getting free investment services from all these professionals. Do not leave money on the table. You heard? So make sure you sort out your pension. That's one of the easiest forms of investing. The second easiest, I would say, is like unit trusts. The whole point of a unit trust is that the risk is diversified and therefore lower. You can look to that. It's a much easier form of investment. I should look to that. Something cheap, something relatively safe, something secure. Make sure you take out your insurance, your life insurance, your critical insurance. Watch my insurance videos to know why. But in a nutshell, you know that life insurance and critical illness insurance are time sensitive. The rates go up literally every single day because it's tied to your age. The older you get, the more expensive the premiums are. Therefore, make sure you go lock down that insurance rate now. Once this is all off the table, once we've sorted out the budget, we've sorted out the emergency fund, we have sorted out the easy forms of investing, now we can look to the debt that you have. And obviously all this time you would have been paying your regular monthly payment. So if they say that every month you need to pay $10,000, all this time you would have been paying the minimum of $10,000. So what we're gonna look at is, should you start investing in like hardcore things like stock market, real estate, that kind of a thing, cryptocurrency, if you have debt. You need to really look at your debt. Not just be like, okay, I know I have student loan, I know that I have an unsecured loan from the bank, I don't even know where the contract is. No, you need to pull up all these documents and you need to really look at your debt. You need to study your debt. You and your debt need to become one. One of the first things that you need to look at is the interest rate. Now, the interest rate is what will make the decision easy or difficult for you as to whether you should invest or focus on your debt. Now, if your interest rate is high, and high is about like say 15% upwards, if it's 15, 20, 25, 35, 45, 55, Macarena, if it's like way above that, then you know that your interest rate is high. And I wouldn't even say 15%, probably 17%. But if your interest rate is high, then I would say your priority needs to be clearing that loan. I'll explain to you using numbers, because you know, numbers, gal. So I'll explain to you using numbers. If you are looking to invest in the stock market, the average stock market return in a good year, or a good market, is around 20%. 20%. So your portfolio will be going up by 20% because you have earned 20%. Now you have this unsecured loan, the interest rate is 25%. What will have to happen is that you are going to be paying 25% of the interest rate is going to be coming out of your pocket, aka your portfolio. So your portfolio is going to have to go down by 25%. So the interest or the returns that you would have gained from the stock market are wiped out by the interest you are paying over on your loan. Therefore, your portfolio is going to remain stagnant. It is not going to grow. Therefore, your interest needs to be on the interest rate. See what I did there? Hope you did. But you need to focus on clearing that loan. Usually these types of loans you can pay on the principal, therefore reducing the interest that is owed, therefore cutting down the time in a fraction of the time. So I'd say focus on your clearing this loan, and then you can invest, because you don't have to, there's a good chance you wouldn't have to wait that long anyway to start investing. But you know, the dollars and cents thing, you want to clear that loan first. The next thing that you need to look at that I would say is important is the duration. And again, I don't think the experts are going to agree with me, but as I said, practicality right here, practical girl right here. If you have a mortgage, say for 30 years, you have a 30-year term in terms of your mortgage. Are you going to wait 30 years to clear your loan before you start investing? That makes absolutely no sense. Furthermore, your mortgage is the type of loan where even if you focus on paying down the principal, unless you come with some dirty money, I mean, if you have a $20 million mortgage, unless you come with like $1 million a year or $2 million a year type of thing, or $5 million a year type of thing, you can probably move from 30 years to 15 years, which obviously is a great difference, it's half the time. But are you going to wait even 15 years to start investing? That makes absolutely no sense. Are you going to even wait 5 years before you start investing when there can be so many opportunities that arise on the market? I don't think that makes any sense at all. But there is a disclaimer. The crux of it is if the interest rate is high. And if you have a high interest rate long-term debt, honey, you need to have that refinance. I don't even understand why the interest. Listen, you need to look into getting that refinance by another institution. Go to another institution and see if they're willing to take over that loan for you. Just explore that option first. The second thing you want to look at is this loan on reducing? So let's say that's not an option. Number one is not an option. The first thing you would do is ask this institution if the loan is calculated, or the interest is calculated on reducing balance. Then you ask them if you're allowed to pay on the principal. If the answer to both is yes, then you need to focus on clearing this loan ASAP, because this high interest rate is zapping the life out of your portfolio. So you need to channel all energy towards clearing that loan. And the reason why I say in this situation, clear off this loan, is because interest rate is high and they're allowing you to pay, the interest is calculated on reducing balance. The balance decreases because the interest is recalculated and that kind of a thing. And the reason why I say to ask if the principal payment or payments on the principal are allowed is that obviously if you pay on the principal, it would reduce how much interest is calculated. So either way, whether it's reducing balance or you're paying on the principal, it will reduce how much interest you're paying over to the institution, therefore allowing you to clear the loan faster and begin your investment journey. But what if the interest rate is low and the duration is long? Well, you invest. That's what I would do. I would invest. So this, the perfect example for this is your mortgage. Average mortgage rate nowadays is about 7%, 7.5%. So what do? You invest. If you have a mortgage for 30 years, interest rate is 7%, you can pay that off. You can pay the mortgage at the same time that you're investing, because the interest is not that much anyway. If the average stock market return is 20% and the debt is 7%, the stock market returns are actually taking care of the interest that you're paying out, and you'd still be making a profit, you'd still be in the black. So I'd invest. I would do both at the same time. So should you invest if you have student loans? Should you invest if you have a car loan? Should you invest if you have unsecured loans? Should you invest if you have a mortgage? It all depends on the interest rate. It depends on the loan term / duration. It depends on if the interest is being calculated on reducing balance, and it depends on if you're allowed to pay on the principal of the loan. If you can assess these 4 questions and the responses to these 4 questions are favorable, then you may be able to invest while you have debt. If it's not, then you wouldn't be able. I wouldn't invest with this debt. I would focus on the debt and then invest after, only because of the dollars and cents, which I explained in the video. So I hope this video was helpful, guys. I hope the entire investment series was helpful. I hope you enjoyed it. Let me know if you have any questions. Don't forget to like, comment, make a comment, guys. I realize I wanna ease up on this commenting. Come on, we could have some conversation. Just drop a comment in the comment section. Let me know what I want to do. Share it. I love how you guys have been sharing. Every time I make a little 2 scroll on Instagram, I see somebody on top of the video, them somebody like it, I'm gonna go and share it so we can spread the knowledge. Make sure say we are make a dent in financial illiteracy in Jamaica, right? And what else? Like, comment, subscribe, and share. Right, that's it. Alright, guys, I'll see you in my next video. Bye.